even if you just look at the rule of 72, right? Take 72 and divide it by whatever the return is per year, and that's the number of years it takes to double your investment. So 72 divided by a 7% return, it takes 10 years to double your money. But if you make 50% in a year, you're really doubling your money almost a little less than every 2 years. So those have like massive effects. I wouldn't say it's one or the other. I say you've got to break out into different strategies. Some long-term, some shorter term, some large cap, maybe dividend focused. And we're just one of those strategies to have. That's like, I'll take 5 to 10% of my portfolio and I'll put it towards this sort of event-driven investing. And if it does well, maybe I'll allocate more towards it. I have my long-term, 401k that I'm not going to look at. So it's additive, but at the same token, when things go badly or when you get into an environment that's very volatile, where you don't know what the future holds, and I think we're in one of those patterns right now. We're sort of like, is this a soft landing? Is this a hard landing? What's going on with the $36 trillion worth of debt? Are they going to pass a budget in Congress this year?
Yes.
Are we going to get another Moody's downgrade? What's going to happen with all this global conflict? Like, we're at that moment where if you're holding on to a lot of stocks, you could see a massive downturn very quickly. Now, on the other hand, if you're in cash and coming in and out of positions very quickly, you can make 7% in a day. Go back to cash safely. You don't have to wait, 350 other days to make that 7%. So, those are strategies to use in a volatile market. Go back a year and, or go back to 2021, we're just throwing money out at everybody and it's a massive bull run. That's the time you can just buy the index and let it rip. But for certain times, this makes more sense. And particularly in bearish environments too, like in 2022, everything's going down, it seemed. But the truth was there were pockets of the market that were performing really well, that were interest rates sensitive on the positive side. And so you have to be able to know where to look and how to find that. And if you don't know, because you haven't spent 20 years, in Wall Street or, managing money, this is the only way to do it. You have to have the AI looking for those opportunities. Say, hey, I found, I looked through 6,000 stocks. I found these 3 bullish events. Why are these companies bullish? Well, war is good for some companies. Raytheon and Lockheed Martin, and it's a great time for them. Crappy time for everybody else. So that happens. But if you're, not so savvy that you can connect the dots for the global economy on every data point, which is, I think, 99.99% of people, you need a little extra help of like why these things are happening. And so that's what we've built this platform to do. And we're going to continue building, to make it better and faster and look at more things, put things together for people. So I'm excited by it. I mean, love it. I use it myself every day. Told my wife when I started the company, like, one way or another, it's going to be successful. If not for, the business purpose, I'm going to use it for myself and still make money, which I have been.